Hi, Frank McLaughlin here. It's great to see you. I have so many people and families that ask me about Roth accounts, and they are an extremely powerful tool. It's a way to potentially grow your assets and get tax-free growth on that money, which is what we're all looking for. But there's a number of different rules that can make them extremely complex and difficult to understand, even for professionals. And so I'm hoping with this video to break everything down and make it a lot more clear for you on how you can take advantage of an account like this. So there's three main areas to remember when thinking about different rules. One, there's Roth contributions themselves, and I'm just talking about the money that you contribute, the money that you put in. The earnings and growth, that's separate. Number two is Roth conversions, or funds that you convert from a traditional retirement account, such as an IRA or a 401k, and again, just the conversion amount there, not the earnings and growth. And then number three is the earnings and growth portion and the rules that you have to follow there for taking out those funds. So let's get started. First, starting with Roth contributions. Now, for the year 2021, you can contribute up to $6,000 per year into a Roth IRA. And if you're over 50, you can contribute $7,000. Another item that's important to remember with contributions is that you have until tax time to file. So that means I have until April 15th of this year, of 2021, that I can still count it as a contribution for 2020. So you have the full tax year, which gives you a couple extra months if you missed last year to contribute. Now, when you're thinking about withdrawing contributions, you can withdraw them at any time, tax-free and penalty-free. So that's an easy one to remember and a great place to start. Next, with Roth conversions, the whole idea of a conversion is moving money from a traditional retirement account like an IRA or a 401k into a Roth account. And when you do that conversion, you pay taxes at that point in time. And the whole idea or the benefit behind them is gaining control over when you pay taxes, looking to ideally pay them in a lower tax bracket as opposed to waiting and paying them when you might be in a higher income tax bracket, and then getting tax-free growth as well, and also getting to avoid things called required minimum distributions that start at age 72. So now Roth conversions are very complex, and I wouldn't recommend just diving into them. You'd certainly want to speak with a professional beforehand, but I do want to help you understand the rules of when you can withdraw after doing a Roth conversion. Now, there's two things to remember here: your age and a 5-year clock. And so, first off, if you're over age 59 and a half, there is no 5-year clock that you have to worry about. So if that applies to you, go ahead and check that box. You won't have to worry about it. And again, here I'm only talking about the Roth conversion principle, or the amount that you convert itself, not talking about the earnings and growth yet. And so with this amount, the taxes have already been paid. You do that when you do the conversion itself. Now, if you're under age 59 and a half, you need to wait 5 years from when you do the conversion to be able to withdraw that principal, the amount that you converted, and avoid any penalties. If you're under 59 and a half and you don't wait the full 5 years, then you're going to be hit with a 10% penalty, which is pretty steep and something you want to avoid at all costs if possible. Now, one way that conversions differ from contributions is that with a conversion, it needs to be done within the calendar year itself. So typically January 1st to December 31st. You can't wait until you file your taxes in the next year to get a Roth conversion done. Also important to note that there is a new 5-year clock for each conversion that you do. And again, this only applies if you're under age 59 and a half. But, and this is just a theory here, not a recommendation. One way that you could access retirement funds before age 59 and a half, in theory, is that if you had money in a traditional IRA, you could do a Roth conversion, wait 5 years, and then you would be able to access that principal or that amount that you converted tax-free and penalty-free, even if you are under age 59 and a half. And so not something that I often see, but in theory is something you could take advantage of if needed. Now, point number 3, with Roth earnings and Roth growth, you need to satisfy both the age 59 and a half mark and the 5-year waiting period. Now, luckily, your 5-year clock starts whenever your first Roth contribution or conversion was made, and that clock doesn't restart. So if you made a conversion 6 years ago and then made a contribution this year, for the earnings and growth, the 5-year clock is already satisfied. But again, you need to be 59 and a half and satisfy that 5-year clock to avoid a 10% penalty and having to pay taxes on that money. So another point in theory here is that if you're age 59 and a half but haven't satisfied that 5-year clock yet, since you're over age 59 and a half, you can avoid paying a penalty on withdrawals of the growth and earnings, but you would still pay taxes on that money. So again, that's just another theory for you and not something that I would recommend, but just to help illustrate the point here. So again, Roth accounts can be extremely powerful and a huge benefit toward your retirement. I hope today's video has made things a bit more clear. If they still feel clear as mud, feel free to reach out, and I'm happy to walk you through all the different rules and see if a Roth account may be right for you. Talk to you soon.